Okay. Hello, everyone. A warm welcome to you all. I, on behalf of Women and Young Members Excellence Committee, welcome you all to this virtual series on Unleash Your Potential, Learn, Upskill, Excel. This series is one of Women and Young Members Excellence Committee's initiatives to augment the knowledge and overall confidence building of the members presently working in industry, corporate, but aiming to switch to practice, members who are on career break but want to resume their professional career, or members aiming to widen their area of expertise in respective professional domains. This series will also be helpful for members at large in enriching their knowledge and overall confidence building by keeping them abreast with the latest amendments in diverse fields. Today, we are going to cover session on TDS and TCS. For today's session, we have CA Neena Kapasi ma'am and also CA Shreya Jain ma'am. The first session belongs to CA Neena Kapasi ma'am. Do we have Vice Chairman sir here, or shall we proceed with the introduction of our first speaker? Okay, I think Vice Chairman sir is not present. So we'll proceed with introducing our esteemed speaker. Our first speaker, CA Neena Kapasi ma'am. She has an illustrious career. Coming to her education and academic background, basically, she is a law graduate from Government Law College. Coming to her professional work, she is a practicing chartered accountant, practicing in the fields of taxation, audit, and management consultancy. She is a core group member of Bombay Chartered Accountants Society. She is a regular speaker at seminars and workshops organized by ICAI, BCAS, CITC, WRC, and many other professional forums. She has co-authored Handbook on Role of Women Directors published by ICAI in 2020. She is a regular contributor of articles in magazines, newspapers of professional interest, including BCAS Referencer, BCAS Budget Booklet, Economic Times, Times of India, Vyapar, Outlook Money, many other publications. She has led various group discussions and addressed lecture meetings on taxation, finance, and investment. She has co-authored e-learning modules on TDS prepared by BCAS. She has co-authored Outlook publication, Layman's Guide to Income Tax. She is an independent director in Apar Industries Limited and also chairperson of Audit Committee. She is also a trustee of Akshara, an NGO engaged in women's issues and pioneer in Helpline 103. Coming to her work profile, she has handled tax and audit assignments of firms, companies, and LLPs engaged in variety of sectors like real estate, jewelry and jewelry manufacturers, government manufacturers, stockbrokers, textile business, chemical business, and many other sectors. She has provided business consultancy services to SME sector to achieve sustainable growth. She has also provided business consultancy services for exports and FEMA-related matters. She is an expert in drafting of various deeds and documents. She has also provided expert consultancy in preparation of will and succession planning. She is also a financial analyst. With these few words, I welcome the first speaker of our session, CA Neena Kapasi ma'am. Over to you, ma'am.
Thank you, Sita, for your kind words. Good evening, friends who have joined from nook and corners of the country. I am really thankful for ICAI for giving me this opportunity. And I'm sure this SETU initiative by WIMEC committee will help will build the bridge between the professionals' excellence and the society's and business community's expectations from the profession. Now, coming to the subject proper, this TDS, it is huge and it is, hold on, just, can you see the screen?
Yes,
Is it
ma'am.
visible?
Yes, ma'am.
Yeah, hold on, I'll just, okay. Yeah, so now this is to hello. Am I audible? Yeah. This subject within a period of 1 hour is like putting a gagar in a sagar, but I will try to do justice within this 40-50 minutes which have been allotted to me. And my focus will be to give you overall scheme as well as to discuss the current amendments which are very distinct and very necessary for us to understand. Now, this TDS, if you see that overall scheme, the overall direct tax collection, which has reached to some 16 lakhs 50,000 crores in financial year 22-23. If you see the total collection of TDS will be something more than 8 lakhs crores, which is a huge sum for anyone to consider. So now this, of course, this uh, I'm not able to get the data of latest years, but I'm sure with expanding TextNet, TDS net, the collection must have reached that. Now, why it is so important? If you see our ancient philosophy of tax collection is that the king should collect the tax just like a bee who collects honey from the flower, without harming anything. And what better thing it can be other than TDS, where the TDS is collected by the tax, where the payer, and where because it is not directly going out of your pocket, you are not paying yourself, the pinch is the least. And the collection is the most because he is on the onerous duty of being a tax collector on behalf of the government. And if you consider that it goes with the government's overall scheme of digital tax administration. Now, whatever TDS has or TCS has been collected, and it has to be paid within due time. It has to be reflected in. You have to also upload this quarterly statements, and finally, the focus will be that it will get reflected in your 26 AS and AIS, and with that, the correct reporting will happen in your income tax return, and the government will get the proper revenue on the income generated by the taxpayers. Secondly, if you see the overall scheme, everything is going towards digital textbook. Your assessment and your this appeal is also becoming faceless. You are sharing constant information between CBDT and CBI. So that is income tax and GST data are constantly exchanged between two of them, so as to say that there is no revenue leakage. And there are various data mining techniques and latest AI tools which have been adopted so as to collect the data from all sources and identify inconsistencies across various filings and legislations and make a proper non-intrusive assessment based on reliable data. So unless and until this TDS and TCS is very much in place with all the safeguards, all the parameters, the digital tax administration move will not happen. And considering our economy, which is so complex, so wide, so varied, and with the online transactions, it is evolving so quickly. Unless and until this government administration of TDS keep pace with this, the entire digital tax administration will take a hit. Now, coming to this, what is it? For tax deductor, though it is a honorary tax collector, the duty is onerous. It goes in the philosophy with pay as you earn to deduct as it is being earned. Now, it starts with the obtaining of 10 for TDS and TCS, and for that you have to apply in Form 49B. Generally, this is the situation, but there are certain exceptions like Section 194IA, which is a purchase of immobile property, or Section 194IB, that is the payment of residential rent, or Section 194M, payment in excess of 50 lakhs for a personal expenses. So in 3 cases, there is no requirement to obtain PAN, but in such cases, the TDS challan will only act as a TAN and as a quarterly statement also. So as far as deductor is concerned, there is no additional financial burden. If he has to make payment of interest of rupees 1,000, he has to make only 1,000 only. But he has to make payment of 900 rupees to the payee and 100 rupees payment for TDS and make the payment in government treasury. But for that, he has to go through the entire process. He has to make deduction on the right amount, at the right rate, and under right section and in time. Rate will not include surcharge or sales except salary. Now, whatever rate is given, say for example, on interest it is 10%. On contract it is either 2% or 1% if it is individual or HF. Under 194J, that is professional fees, it is 10%. 2% if it is technical fees. Then in such cases, it will be flat 2% only. In such cases, you do not have to include surcharge or sales. But as far as salary is concerned, you have to add this surcharge and sales because you have to go on the total tax payment on salary, which is a taxable in your employee's hands. So other than surcharge and sale, other than salary, you don't have to consider surcharge and sales, and it will be flat tax. However, if no payment is prescribed, then the tax deduction will be at higher rate, which is a higher of rate or 20%, whichever is higher. And if your payee, he has not filed his return of income of earlier year, whose date of filing has already gone, in that case, in such a case of non-filer, you have to make deduction at higher of twice the rate or 5%. Now, having deducted the taxes, you have to make payment to government treasury in time, that is Challan INS 281. After making the payment of taxes, you have to upload quarterly statements. That is in 24Q if it happens to salary, if 26Q in payments other than salary, 27Q which is meant for non-residents, and 26QB for other payments. Once uploading these quarterly statements, your job doesn't stop there. You have to download this TDS certificate in form 16, 16A, 16B. There are 2, 3, 4 various forms from NSDL's site, and you have to send it to your payee. So your job doesn't end there. You have to download the certificate and you have to send. Now, generally, this is applicable to business communities, that is partnership, LLP, AOP, BOI, companies, etc., cooperative societies as well. But it is not applicable to individual or HUF unless turnover or gross receipts of business or profession. In case of a profession, it is a gross receipts of immediately preceding financial year is a 1 crore, and in case of a professional, it is 50 lakhs rupees. Earlier, the provision was that if you are liable for tax audit in preceding financial year, then you are liable for TDS in current financial year. However, with considering various provisions affecting tax audit provisions, section 44AD, 44ADA, 44AB, now there is the limit is vis-a-vis the absolute amount, that is 1 crore in case of a business and 50 lakhs gross receipts in case of professionals. However, there are certain exceptions, like for example, section 194IA, which is with respect to payment for purchase of immobile property, or 194IB, purchase of payment of residential rent, and 194M, personal expenses more than 50 lakhs rupees. In such cases, there is no applicability of your turnover or your gross receipts, or you being in a business or profession or not. You have to deduct the taxes. Now, what are the rights, or what are the rights of payee? Now, payee, though he is entitled to only net amount. So, in earlier example one, we have considered that the 1,000 rupees interest, 10% TDS, that is 100 rupees, is deducted, and the person will be entitled to only 900 rupees. He cannot demand that, please you pay me 1,000 rupees. He will be receiving only 900 rupees. That is a net amount. But definitely his taxability on gross amount, that is, he will be taxable on gross interest of rupees 1,000. At the same time, he will be eligible to get credit of TDS and TCS by offering his income in the assessment year where it is getting taxed. So for example, I'm getting professional receipts in current financial year. So if I am receiving my professional receipts in current financial year, the relevant TDS on my professional fees, which has been deducted by client, I will be able to get the credit in this year. However, I have issued a bill, which happens in practically all professional case in current financial year. The client has deducted TDS on the same, being on mercantile system, but he makes the payment in next financial year. So I, being a professional following cash method of accounting, I will offer my income on next financial year. In such case, I will be eligible to get credit of TDS, which is appearing in 26 AS of my earlier financial year. So as it went, as per section 199, read with rule 37 BA, I will be eligible to get the credit only when I offer the relevant income for taxation. I do have a right to apply for lower deduction of tax or nil deduction of tax to AO by making an application in certain cases which have been prescribed, or submit form number 15G or 15H in case of a senior citizen wherever applicable. Now, this privilege to apply for lower deduction of tax or nil deduction or submit form 15G, 15H are not all inclusive. It is not eligible. It is not applicable to all sections, but certain sections and subject to certain conditions. But at least, there's this eligibility to claim lower deduction is there for certain things. Now, if you see the general scheme, when I started my practice long back, my senior used to tell me that, whatever expenses are there, you check whether that TDS applicability is there or not, or whether he has deducted TDS or not properly. So I used to check, all expenses of revenue nature. Say, for example, salary under section 192, interest under section 193, 194A. 193 is in respect of interest on securities, and 194 is other interest. Dividend under section 194, contract fees when you are making payment under section 194C. Professional fees under section 194J, rent under 194I, commission under section 194, and 194G. Generally, these expenses are eligible for TDS whenever I am debiting or I am making the payment in advance, whichever is earlier. So generally, we used to check all these expenses, and subject to the conditions prescribed in each section, one is to check whether TDS is properly deducted or not. Say, for example, if the interest is provided on partner's capital account, it is excluded from the purview of section 194A. Or, for example, if the contract fees have been provided, which is less than 30,000 in a year, then 30,000 at a time, then in that case, there is no need for me to deduct taxes. Or 194J, if the professional fees payable is less than 30,000 rupees, we need not deduct taxes. So subject to conditions specified in this section, one used to check. Now, see the net, how it is getting expanded. Now, it is also getting expanded to capital expenditure also. Of course, purchase of goods is not a capital expenditure. But earlier, we used to say that except purchases, you check all the expenses. Now, under section 194Q, when you are purchasing goods, you are covered under section, under this TDS. When you are buying a immovable property, in that case also, though it is not relating to your capital expenditure, it may be your personal purchase, in your investment. In that case also, if it is exceeding 50 lakhs rupees, you are supposed to deduct taxes. Please, I would just like to remind you one amendment which has come with effect from AY 22-23, where if you have purchased a property more than 50 lakhs rupees, the TDS will be deducted on stamp duty valuation or agreement value, whichever is higher. So, for example, if you have purchased a property of at the agreement value of 70 lakhs rupees, but the stamp duty valuation is 1 CR, then TDS will be required to be deducted on 1 CR and not 70 lakhs rupees. This is to take care of Section 43 CA and Section 50C and Section 5627 applicable. Now, not only this, just see how this TDS provisions are getting complex day by day. With evolving economy, the government is also keeping pace and trying to unearth all the transactions and trying to plug the leakage in tax revenue. So now e-commerce transactions are also covered under Section 194O. Crypto transactions, which one doesn't know what is happening in that dark net, that are also covered under Section 194S. And what a complex net it is, we will discuss as and when we come to this. But considering that crypto exchanges are so complex and they are so having a fantastic system, I'm sure they will be able to take care of this even complex TDS provisions. Now, online gaming, you all know that it is so much into work, So that has also been covered with Finance Act 2023. That also we will discuss in next slides. Not only this, when you are withdrawing cash, which is your own cash, which is lying on your savings bank account or current bank account, then also if it is exceeding certain limit, TDS will be deducted under Section 194N. Personal transactions from non-business entities. Like last year, one of my high net worth individual, he renovated his house and paid some 1 CR for his, beautiful duplex apartment. So when he was just an investor and having no business income, and when I looked at it, I said, you are eligible, you are liable for TDS at the rate prescribed rate under Section 194M, which is 5% more than 50 lakhs rupees. Once you have crossed 50 lakhs, you have to make payment under Section 194M. So he was a bit surprised that how it is possible. But the government also would like to check, this activities of these high net worth individuals also. So when any commission or professional fees or contract fees have been paid more than 50 lakhs rupees, in case of even known business entities, in such case also TDS at the rate of 5% is applicable. Even residential rent, when you are making a payment of 50,000 per month, the same is liable for TDS under Section 194 IP. LIC maturity is also taxable under Section 194 DK. Your own investment getting matured, and on that also subject to the taxability and exemption under Section 1010D and other relevant provisions, the balance will be liable for TDS under Section 194 DA. How is this? What is this key? Now, deduction is at the earliest, payment or credit, whichever is low. So even if you are getting some credit, but once you are making the payment or once you are debiting to pay's account, immediately you have to deduct, and the payment should be done by 10th of next month. Only when the payment is deducted, only when the TDS is deducted in month of March, the payment you can do it by 30th April. Quarterly statement is by end of 1 month from the end of the quarter. So only for March quarter, the last payment date it is 30th April. So one can file by 31st May. So all of you should gear up and make the pay and see to it that your clients upload their quarterly statement of last quarter of 2023 by 31st May. For TCS, the days are the due date is 15 days early. That is, they have to do it within 15 days from the end of the quarter. And what are this? If they don't do it, there are late fees of rupees 200 per day for late return filing under Section 234E. I have tried to give this chart. This is form number 24Q and 26Q, which is applicable to TDS on salary and other payments. The last date is, as I told you, that within a period of 1 month from the end of the quarter, that is Q1 is the 31st July, 31st October, January and May. So that will applicable to 24Q, 26Q and 27Q. For 26QB, it is not quarter wise, but TDS on sale of property, that is 30 days from the end of the month in which TDS is deducted. And form number 26QC, it is TDS in rent, it is 30 days from the end of the month in which TDS is deducted. In both the cases, you did not obtain 10, you did not upload your this TDS statement also. Only your challan will act as your TDS statement. Now, having uploaded your TDS statement, your job doesn't stop. You have to download form number 6, TDS certificates in form number 16, 16A, 16B, and 16C. And you have to submit to the pay. So it is not that, okay, you have uploaded your statement, the credit is appearing in there 26 As and AIS, your job ends. No, it is not that. You are supposed to send your TDS certificates. You have to download the certificates and send all those certificates to the respective page. Then only your job ends. What happens, if you do not perform your duty? Then so basically you are a government's honorary tax collector. For going through this onerous job of tax collection, tax payment, statement uploading and delivering the TDS certificates, your job doesn't give you any credit. But at the same time, if you are default, then there are enough safeguards, to penalize you, to make you liable for interest, to make you liable even for prosecution. So one has to be very careful. Let us study what the issues are. So if you do not deduct or post deduction, if you do not make the payment, then you are considered as an assessee in default under section 201, subsection 1. Exception is only when deductee has paid the taxes, he has filed his ITR including such income, and where he is submitting his CA certificate in this regard in form number 26A. What are the consequences? If you are assessed in default, then you have to make payment of tax under plus interest. Only in case of when the deductee is already paid, then in that case you do not, but otherwise tax plus interest. Now, interest is mandatory and compensatory in nature. So even if you have some reasonable cause, okay, there was a flood and you could not go to the bank, or the bankers were not functioning, or during Corona times, there can be reasonable issues also, all this, beyond your possibility. But then also this is immaterial and all these things, you have to make the payment of interest. Now, interest under section 201(1)(a) to be paid before filing the statement as required under section 203. So interest is mandatory, compensatory, and reasonable cause is immaterial. So what is the rate of interest? If your interest is already deducted and if you have not paid it, then it is 1.5 per month or part of the month. But if not deducted, and you are deducting, then it is at the rate of 1% per month or part of the month from the date in which it should be deductible to the date to which it is deducted. Even in case of payment of taxes by deductee, who has already paid the taxes, submitted you a certificate under section in form 26A, in that case also interest liability is there on you, where interest is liable from the day and when the tax was deductible to the date of furnishing ITR. Now, penalty under section 271C is also there, which is there are various penalties. There is one penalty under section 271BB1A, which is for failure to apply for 10 or for non-quoting of thereof. So if a person who is required to quote his TDA 10 in the challans or certificates or statements, and he quotes a number which is false or which he believes not to be true, then such person may be liable for penalty, which is a 10,000 rupees. There is one more penalty under Section 272A 2K for non-filing of TDS return, where a penalty of 100 rupees per day is prescribed. There can be a prosecution under Section 276 for failure to make payment of TDS when it is deducted by you, or for failure to make payment of TDS which is collected by you, which can be very heavy, which is with a rigorous imprisonment for a term which shall not be less than 3 years, but which may extend to 7 years with fine. Now, there can be other issues also, like but as far as penalty and prosecution is concerned, please note that it is not automatic. It is not mandatory. It is all subject to reasonable cause. So if the notice will be served to you, proving that it should not be levied on you, and if you provide a reasonable justification for delay or for late payment or for other things, then this penalty is not automatically, and it may not be levied. There is another thing, that is a disallowance under Section 40A1 and 40A1A, where in case of the expenses which are liable for TDS, and which TDS you have not paid before the due date of filing return of the income under section as prescribed under Section 139(1), in that case the 30% of such expenses will be disallowed under Section 40A1 and Section 40A1A. However, of course, this deduction is not lost. As in when you make the payment of such TDS in future, in that financial year, the expenses that this 30% disallowance will be granted to you. So, for not following proper TDS procedure as a government's honorary tax collector, there are various consequences, and which can be really fatal at times. Let's come to amendments, which are recent amendments either by Finance Act 2023 or Finance Act 2022, but which we should not miss it. Now, TDS on payment of accumulated balance due to an EPF at 10% is required to be deducted on lump sum due to an employee for balance of employees' provident fund. If the amount is exceeding 50,000 rupees. Now, there was one requirement which said that, the person should submit PAN to the employer. And if it is not submitted, then TDS will be at 30% in place of 10%. Now, that particular provision has been amended, has been deleted. So, with that, TDS will be either at 10%, or if it is not PAN is not submitted, then it will be at 20% consequent to amendment under Section 206 AA, which says that if you have not submitted PAN, that TDS will be at higher of twice the rate or 20%, whichever is higher, but higher limit of 30% is dropped. Now, this is a very relevant relevant amendment. Section 193, which provides for TDS on interest on securities, it used to give exclusion of interest on listed securities which are lying in a demat account. So, say for example, if your debentures of a particular company which are listed on stock exchange are lying in your demat account, and if you are getting interest thereon, then that TDS was not required to be deducted under Section 193. That was the exclusion. Now, with effect from 1/4/2023, that exclusion has gone. With exclusion gone, now TDS will be levied on this interest on debentures which are listed securities and which are lying in demat account. But just consider why this amendment has come, please. Because what used to happen, that there is an interest income from listed securities, no TDS has been deducted. There is no reporting in 26As. There is no reporting in AIS. So either the assessee used to lose sight of such things, or they, even when they lose it, sometimes there is no means to the government administration to check whether this receipt has been offered to tax or not. So to prevent leakage of tax, this has been amended. Now, there may be various issues, when you are purchasing such securities in secondary market. Say, for example, there is a debentures which are having an interest rate of 10%, and interest is due in 30th June. Okay, so now you are purchasing in May, which is a 50,000 rupees is a principal amount, and which includes interest of 3,000 rupees. So 53,000 rupees you are giving accrued interest till date, till 31st, till 15th of May. Okay. Now, when this in June, when they will give you 5,000 rupees interest for first quarter, that 3,000 is basically for you, it is a cost because you have already paid for accrued interest to your seller. But in your 26A, that 5,000 rupees interest will be reflected with 500 rupees TDS. You may take, when you want to take credit of 500 rupees, and when your interest income is 2,000 only, because 3,000 is for your cost, you have already paid to the interest accrued to your seller, then there will be a mismatch and the issue may come. So these issues are going to come, we have to resolve. Now, this is a new animal which has come with effect from 1/7/2022. However, considering that, it is such a serious in nature and it is so wide, pervasive, that one has to consider this. So the main purpose of introducing this section is to avoid tax evasion. Now, what happens, previously the business, while giving the perks, benefits, and other non-monetary benefits to their dealers, partners, and other persons, claimed it as a business expenses. Because for them, it is a very valid business expenses, incurred during the course of the business for the purpose of the business. But when the person who is receiving such benefit was not showing their income, because there is no trail for such income. Okay. For example, a company taking all the agents who have achieved their sale targets, to Goa for the vacation, the company will validly claim these expenses because it is for their purpose of, business. But this Goa pleasure, that perquisites which all these dealers or distributors have received, that will not be reflected in this agent's income, distributor's income, which should be there as per section 28(4), or benefits or perquisites received during the course of the business or profession. So take a case of even this social influencer. They are getting benefits or perquisites which may go into lakhs of rupees. The company, the entity which are paying to them are getting valid claim. But who is offering, So just to plug these loopholes, Section 194R has been introduced with effect from 1st July 22. So now the tax is required to be deducted at 10% of value on payment of benefit or perquisite to a resident on monetary or non-monetary consideration. So whether the payment is made in kind or in cash or partly in kind or partly in kind, all these payments are covered and arising from business or profession. So if it is paid to resident, non-resident, it will be covered under Section 195. If it is paid to an employee, it will be covered under Section 192, not under Section 194R. What is the threshold limit? The threshold limit is rupees 20,000 in a financial year. When a payment is made in kind, it is also covered. If it is fully in kind, then he has to assure that TDS has been paid by the deductee before such payment has been done by payer. In case of individual or HUF, again, it is not applicable unless and until that limit of 1 CR for business and 50 lakhs in case of a professional is there in the earlier financial year. There are so many anomalies and so much of clarification is required that CBTTA has issued circular number 18 to 2022, which gives you FAQs. And now, rather, of solving these queries, the CBT has generated more questions. Now, such TDS liability can be discharged either by grossing up for example, if it is paid in kind or partly in kind and partly in cash, then how do you handle this? So either you grossed up this net amount or by paying the tax from his own pocket. So say, for example, if you have paid him 90 rupees and TDS is at the rate of 10%, so you consider that your payment is 100 rupees and make payment of TDS of 10 rupees from your own pocket. Or by recovering the same from payee either by cash or from reducing the credit balance with you, if any, or by ensuring that the payee has discharged the liability by way of advance tax, you obtain the challan before you release the payment or before you release this benefit or perquisites. As I told you, if it is employee, then it is covered under salary, and if it is non-resident, it is 194. Again, this is there will be, if you default in this, not only you will be violating 194R, you will be liable for interest, but penalty under section 271C also, and there is a prosecution also under section 276B. Please note this section very carefully. Now, this is TDS under section on income of units of non-resident under section 196A. Earlier, the rate prescribed is 20% on such income. Now, if such non-resident is eligible to get concessional tax treatment under DTAA applicable to him, then he will be eligible to claim lower rate of tax. There is a TDS on cash withdrawal from bank under section 194A, which prescribed rate of TDS rate at the rate of 2% on aggregate withdrawals where it exceeds 1 CR. So if your cash withdrawal in all the bank accounts under say one PAN is exceeding 1 CR, then 2% will be deducted under section 194A. As far as cooperative society is concerned, now this TDS will happen by a banking company or by a post office or by a cooperative credit society engaged in the business of banking. Now, as far as this limit of 1 CR is concerned, the same is been extended to 3 CR in case of a cooperative society. So till the time, in case of a cooperative society, the payment is not exceeding 3 CR from all its PAN connected accounts, the TDS will not be applicable. TDS, of course, in case of if it is non-filers under section 206AB, it will be 5%. This is another new section which has come into this. And this is with, online gaming. If you see this IPL or if you see any good program on this TV or OTT platform, what do you see? You see more all this advertisement on this, online gaming platforms. And sometimes you wonder that what must be the business. But the business is so huge. And there was absolute, revenue leakage for the government because it was happening in this through this in digital area where the government does not have any direct data. So with this, this 194B, the new section has come, section 194BA, that we will discuss. But winning from lottery or crossword puzzle or card or gambling or betting or other games, when winning is exceeding 10,000 rupees, your TDS liability is there at 30%, which is exceeding 10,000 rupees. Now, so online gaming, that, with this, the effect, it will start from 1/7/2023. So within a period of 1.5 months, the provision will start, and TDS shall be deducted on net earnings, from this online gaming at the rate of 30%. But there is no threshold. So even threshold of 10,000, which was there in under section 194B in case of lottery or crossword puzzle, it is not there in case of online games. So even if a single rupee, if you have won, in that also 30 rupees is 30 rupees TDS will be affected. How it will happen, So if you are withdrawing any amount during the year, in that case, on your winning amount, not on that entire withdrawal, because you might have already credited 10 lakhs rupees and you might have earned 30,000 on some winning. In that case, 30% on that 30,000 will be deducted under section 194BA. However, if we are not withdrawing any amount, and if we are keeping it till the year end, that entire amount, in that case, whatever is the winning comprised winning in such an amount with lying with this company, in that case, 30% will be deducted. So deduction when you are withdrawing at that time on the winning amount, 30%, plus whatever is the balance lying at the year end, on with that also 30% will be deducted. If partly or wholly in kind, then again the responsible person should ensure that the tax payment is done before releasing the winnings. Because, this may happen that online gamings may provide you some winnings in kind also. In that case, the responsible person should ensure that the tax is paid before releasing. However, in this case, higher tax rate, which we are providing for non-filers under section 206AB is not applicable. There is a default liable for penalty under section 271C and prosecution under section 276B. Now, in case of a certificate of, in case of this certificate to get lower deduction at lower rate or nil rate, this one can apply to AO. Now, this benefit is extended to income received from units of REITs or InvITs under section 194 BA to business trust paying income to non-resident, and TDS will be deducted at 5%. See, in case of a TDS, in case of a non-filers, TDS and TCS at higher rates, So in that, the specific exemption was given to non-residents who do not have permanent establishment in India. Now, this benefit of exclusion has also will not be considered as non-filers, but this specified person shall be notified by central government. And in such case, they are not required to furnish ROI. And in that case, the higher rate under section 206AB or 206CCA will not be applicable. This section 194Q and section 206C1H, there is a, which you are aware, which is there since last 1.5 years. But let us just review the ones. There is a, under section 194Q, the excess deductible under any other provision, say under section 194S or 206C1H, 206C, then in that case, you do not have to applicable section 194Q, because section 194Q will be overlapped vis-a-vis, various other sections also, because the good definition of goods is wide enough to cover other commodities, even securities also, cryptos also. So if it is covered under a specific section, then you do not have to consider under section 194C, 194Q once again. Now, who can be the deductee? Deductee can be a person who is selling to you. Similarly, this is exactly mirror image under section 206C1H, which I understand, this colleague will take it up in detail. Now, this is a 206C1H will talks of TCS on sale of goods. That is, the obligation is on seller. Again, the limit is same. Whereas a turnover of yours is exceeding 10 crores in the preceding financial year, and transaction limit is a 50 lakhs. Here it is again a consideration for sale of goods, and timing is again when you are receiving the money. Here, when you are crediting the amount to the seller's account, that time you have to deduct. Here, the tax collection is only when you are receiving the money. Rate is again same, 0.1%. So, if it is not applicable, if tax is deducted by the buyer under section 194Q or by any other section. So, if the tax already TDS has happened under specific section, then you don't have to go under section 206C1H. And it is applicable to who purchases the goods, but it does not include government, etc., local authority. So this we have already considered. There can be issue like in case of a GA, this 194Q, when your invoice does include GST, but you do not have to consider GST amount when you are debiting the amount to your credit of when you are crediting to your seller's account. But when you are receiving the advances, then the TDS has to be affected on the total amount, which may also include GST amount. Trade discount, rebate, and cash discount will not be part of the invoice, will be deducted from the invoice, and the 194Q has to be affected on a net amount. Stock and commodity exchange transactions are specifically covered under section 194Q. Again, higher TDS wherever 206AA, that is non-PAN and non-tax filer, applies. This is again this TDS on virtual digital asset. Now this is TDS This is also been made applicable from 1/7/2022. Now, deduction of a tax is at the rate of 1% on purchase consideration. So, on payment for transfer of virtual digital asset to residents, and where payment is done in kind, then no TDS, but to ensure tax payment by payee before he released the payment. Threshold is 50,000 for a specified person and 10,000 other than specified person. Who is a specified person? Specified person is the person who is an individual or HUF who does not have either business income or the turnover is less than 1 CR or 50 lakhs rupees in case of a professional. In other cases, it is 10,000. So this is a new thing which one has to consider. There is a good amendment which has come through this, latest. This is will be applicable from 1/10/2023. What is used to happen? There used to be mismatch on account of TDS on account of different accounting method of accounting followed by the payer as well as payee. Say for example, you are on mercantile system. You have raised a bill. You will on mercantile system, being a mercantile system, even though you have not received that amount, you will take that invoice into consideration and offer income for taxation. But the person who has received this invoice for dispute or for different method of accounting, he is crediting he is crediting this bill in year 2. You are crediting in year 1. So there is a mismatch. So the TDS is, there is a mismatch due to different method of accounting. So what will happen? The TDS, your income is offered in year 1, and considering section 199 read with rule 37BA, you should get the credit of TDS in year 1 only. The person who is deducted TDS, he is done in year 2. So your TDS credit is gone in year 2. So income is offered in year 1, and TDS credit should also get in year 1. However, it is not seen in year 1 26 AS AIS. So it is very difficult to get the credit. You will not get the credit. Year 2, when you are getting the credit, that time you are not offering the income. So difficult again on principle, you should not get the credit. So what will happen? So section 155(20) amendment has been introduced, which says that you can make an assessee can make an application to claim the credit in the year in which the income is offered to tax. And such application should be made within a period of 2 years from a financial year in which such tax credit is reflected. And so he will be able to get the credit of TDS. Though this is a welcome step by the government towards simplifying compliances, the prior tax credit issue remains unresolved. Because what will happen? The amendment has come in effect with 1/10/2023 only. So what will happen to the year, which is already done? For so many years, this issue of mismatch is already there. How one can consider this? Now there is a tax audit applicability also vis-a-vis, our TDS provisions. Under clause 21B, you have to report amount inadmissible under section 40A1 and 40A1A. And reporting is also required under section clause 34A, where you have to give your tax audit is not only tax audit, it is TDS audit as such. Where under section 34A, whether you have to report each and everything, whether the assessee is required to deduct or collect tax, his PAN, section under which 10 number under which this TDS has happened, section, nature of payment, total amount of payment, amount liable for TDS, amount on which TDS deducted, and shortfall, if any. 34B also, it requires that you should give the details of furnishing the statement of tax deducted and tax collected, and whether they have furnished properly. You have to give the details. Of course, all these details are available from TRACE's site. And 34C requires whether the assessee is liable to pay interest under section 201(1)(a) or section 206(c)(7). If yes, then you have to give the details. All these details can be downloaded from TRACE's site and can be cross-verified with the details submitted by the client. I thank you for the patient hearing, and 5 minutes I have kept for question and answer, if any, because the subject is so vast, it is very difficult for me to cover this topic. Thank you very much.
Thank you very much, Neena ma'am. It was indeed a very insightful session, and looking forward for the questions. Just a minute, I'll just check once. I feel there are no questions in the admin panel, so would like to really thank you. Firstly, the Women and Young Members Excellence Committee for organizing this excellent 5 days series, wherein we could hear to a range of female chartered accountant friends from all over the country. And secondly, would like to really thank you, Neena Kapasi ma'am, for your insightful session. Your session was really very informative, and minute details that you have tried to cover in such a short span would really help all our participants, ma'am. Thank you for your valuable time.
Thank you.
Yeah. And now let us move to the last session of this series, which would be taken up by our next speaker, CA Shreya Jain. Shreya, are you there? Shreya?
Yeah.
Yes. So Shreya would be taking up on the applicability of TCS, various transactions that are covered, interest, penalties thereon, defaults from traces, and also the procedures for application for lower deduction certificate. So let me take this opportunity to introduce CA Shreya Jain. She's a commerce graduate from Delhi University and an associate member of the institute. Cleared forensics audits and fraud detection and Ind AS certificate course of ICAI. She has worked in the field of audit and assurance during her articleship with Grant Thornton LLP and is now working as a partner with Lunawat and Company. She has a growing practical experience in direct taxation, corporate and non-corporate audits, and has been given consultancy to various corporate and non-corporate entities on taxation and assurance matters. Her area, apart from assurance, is in Ind AS and forensic audits. She has also co-authored the book Chartered Accountants Documentation and Compliance for Audits and Reviews. A really remarkable, Shreya. So welcome on behalf of WMYEC committee, and would like to request you to take over this session.
Thank you so much. Thank you for the kind introduction. Namaste. Good evening to all. Firstly, I'd like to thank Women and Young Members Excellence Committee, headed by Chairperson Preeti Savla Ma'am and Vice Chairman Abhay Chajer Sir, Shanu Ma'am, Jaya Ma'am, and the entire committee for taking this initiative to augment the knowledge, building the members, whether in industry or coming back from sabbatical or trying to pursue into practice. And this time it is direct tax. And I'm going to share and give an insight on tax collection at source, that is TCS. So the contents that ma'am has briefly mentioned that we are going to cover is going to be about TCS, the transactions liable for TCS, lower deduction certificate, interest and penalties, and the traces website. We're going to keep it short and simple, and questions are most than welcome. So we just got to know in detail about tax deducted at source, the TDS. Now here TCS is exactly opposite. It is covered under 206C of Income Tax Act, in which every person being a seller shall at the time of debiting of the amount payable by the buyer to the account of the buyer, or at the time of receipt of such amount from the said buyer, either in cash or by the issue of check or draft, or by any other mode, electronic mode, whichever is earlier, will collect from the buyer of any goods of nature specified a sum that is equal to, as we're going to discuss further. So in TDS, it used to be that the buyer used to deduct an amount and then pay to the seller, the deductor and the deductee. Here it is opposite. It is going to be that the seller is going to collect from the buyer, and it's going to be an amount above the amount that is payable by the buyer. So let's take an example. Mr. Batra purchases a car from showroom that is valued at 24 lakhs. Now the TCS on such value will be 1%, that is 24,000, which is going to be deposited by the showroom, that is the seller. So the total amount is going to be 24 lakhs 24,000. In TDS, it would have been 24 lakhs minus 24,000. But here it is 24 lakhs 24,000. Now TCS is collected inclusive of GST. TDS is exclusive, but in TCS it is inclusive of GST. The seller must have PAN to collect the TCS and is entitled to get TCS credit. Now, as it was mentioned by ma'am as well, that in the tax audit, you're also required to mention the details of the TCS and if there has been any interest on the delay. Now, as we go on to the main area, there are limited transactions. Now the transactions although have increased. Initially, there used to be just two areas, 206C1 and 1C, but now the transactions have increased. So firstly, we go to the 206C1, that is alcoholic liquor, forest produce, and scrap. So we have alcoholic liquor for human consumption. The forest produce, that is tendu leaves, timber obtained under the forest leaves, I'm sure you're well aware. Timber obtained by any other mode, then any other forest produce, scrap, minerals being coal, and here the percentage for the TCS. Now in each transaction, there is a slight change. There may be a slight change in the buyer or seller. So that is why we're going to take the buyer and seller definition for each transaction as we go forward. So for the first one that we have, the buyer is a person who obtains in any sale, but the exceptions to the buyers are public sector companies, government, high commission, legation, commission, the consulate and the trade representation of a foreign state, a club, or a buyer in retail of personal consumption for the forest produced scrap that we're talking about. Now, also, there is an exception for a buyer that is utilizing these goods for the purpose of processing or manufacturing and is not in the process of trading. But this exception will be given to the buyer only and only when the buyer is filing in the form 27C and is giving to the authority and a copy to the seller. So this needs to be applied. Only then the buyer is going to have the exception of not being liable to TCS. The sellers are going to be central government, state government, any local authority or any company, firm, cooperative society, or any individual or HUF having their accounts audited. So these all are the sellers who are going to collect TCS. Next, we have 1C, that is parking, lot, mining, etc. Here, the nature of contract or the licensee or the lessee is going to be for the parking lot, toll plaza, mining, and quarrying. Now, the seller, every person, there is no exceptions. For the buyer, every person, but there is one exception, and that is public sector company. Next, as we discussed in the very first example, now here comes the motor vehicle. Every person being a seller who receives an amount as consideration for the sale of motor vehicle exceeds the value of 10 lakhs shall, at the time of receipt of such amount, collect from the buyer a sum equal to 1%. Now, who all are the buyers? Any person who obtains in sale, but the exclusions, as we discussed, the government, CG, SG, High Commission, local authority, or here there is an addition to the exception, and that is public sector company which is engaged in the business of carrying passengers. The sellers are the same. It's going to be any company, firm, cooperative society, individual, or HUF having their accounts audited. So here we're talking about the tax audit limit for the individual or HUF. So only if the limit is exceeding, and that is they're getting their tax audited, they have the tax audit, only then you're liable to collect TCS. Now, this is something which has been always the talk of the town when it comes to TCS. And here we are with Overseas Store and Liberated Remittance Scheme. So let's go one by one. Now, there is going to be a change from 1st July 2023, roughly around 14-15 days from now. The rates are going to change. We're going to discuss what the rates are currently and what the rates are going to be. So firstly, we have Overseas Store Program, where right now it is flat 5%. We all know when there is no PAN, the rate gets doubled. So instead of 5, it is going to be 10. But from 1st July, it is going to be flat 20. So from 5, there's going to be a flat jump of 20%. Now let's understand Overseas Store Program. Now here, if I'm going abroad and I'm booking a ticket from Make My Trip, here I'm not liable for TCS. There's not going to be any collection of TCS from me. Where Overseas Store Program means that you have a travel agent who's booking tickets for you, who's doing the lodging, who's doing your hotel tickets, who's looking at the excursions over there. So a complete tour program is being done by a travel agent. Then the TCS will be collected, which will now going to be 20%. Next, we have LRS for education and medical treatment. Now here the TCS is 5% in excess of 7 lakhs during the financial year. So we have a cap of 7 lakhs during the financial year, and there is going to be no change from 1st July. It's going to remain the same, and that is 5%. This is for the case of education and medical treatment. So what does this mean? So if I'm here and abroad, if I'm going abroad, so even from my bank account, my Indian bank account, I want to remit some amount exceeding 7 lakh rupees, then I need to give 5% as my TCS. So this can be for either for my education purpose or for my medical treatment. Then next, the remittance again related to studies, but the source of fund is education loan. So if a student is going outside and is going out for studies basis an education loan, then the TCS amount is going to be 0.5% of the remittance in excess of 7 lakhs during the financial year. So here also we have the cap of 7 lakhs, but the rate is less. We have the education loan, which is 0.5%. This is going to remain same even after 1st July 2023. And if we don't have the PAN, then the amount is going to be 5% instead of 0.5%. Now we've discussed LRS for education and medical treatment. Now when it comes to other than education and medical treatment, then currently it is 5% like education in excess of 7 lakhs, but from 1st July 2023, it's going to be 20% in excess of 7 lakhs. So in overseas program, we see 5, it becomes 20%. And other than education, medical, if we have the LRS, then it is from 5 to 20% after the cap of 7 lakhs. Next we have, this was discussed, just a gist of it, but here we'll discuss more, and that is the sale of goods. Every person being a seller who receives an amount as consideration for sale of any goods of the value or aggregate exceeding 50 lakhs in any previous year, other than 1. Exports, or covered in subsection 1, that is the forest produce, the scrap, or 1F, that is the motor vehicles that we discussed, or 1G, overseas program or LRS, shall at the time of receipt of such amount collect from the buyer a sum equal to 0.1% of the sale consideration exceeding 50 lakhs. Now firstly, if there's no PAN or Aadhaar, it's going to be 1%. So now this section says that if the value of the goods during the previous year exceeds 50 lakhs rupees, then the sum is going to be 0.1%. The TCS amount is going to be 1.1%. Now, what are the exceptions? The exceptions as discussed: motor vehicles, exports, LRS, overseas program, and forest produce. Now, a buyer. Who is a buyer? A buyer who purchases any goods but does not include central government, state government, an embassy, high commission, legation, commission, consulate, and the trade representation of a foreign state, a local authority, or a person importing goods, importer. Now, seller here is going to be a person whose total sales, turnover, or gross receipts from the business exceeds 10 crores. So only if from the last year your 10 crores turnover is exceeding, then you'll be liable to collect TCS over 50 lakhs. So suppose if my sale of goods is 60 lakhs, then the TCS amount of 0.1% is going to be on the balance 10 lakhs and not on 60 lakhs. Yes, so right here is now what I'm going to mention, that there may be no need of collecting TCS under section 206C1H if the buyer is liable to deduct TDS under section 194Q and such amount has been deducted. Okay, in the TDS return form 27EQ. So as Neena ma'am discussed, so if the TDS has been deducted by the buyer under section 194Q for the purchase of goods, then TCS is not required to be collected. Now let's take an example. We're going to discuss lower deduction certificate, but we know the gist of it, right? So if the seller has a lower deduction certificate, then the buyer is not liable to deduct TDS under section 194Q, right? So what happens to the TCS applicability? Because the buyer will not deduct the TDS under section 194Q. Now, in such scenario, the TCS will be applicable. The TCS will be applicable because TDS under section 194 is not being deducted. Now, points to be noted, it's on goods and not on receipts, and it is on receipt. So in TDS, it is receipt or making the bill, whichever is earlier, but under section 206C1H, it is only on receipt. Interbranch sales. Will TCS be applicable in case of interbranch sales? No. You're selling to your own branch, then TCS will not be applicable. Now we've discussed all the transactions under which TCS will be liable. However, tax will be higher, that is 5% or 2 times, not more than 20%. If the specified person has not filed the ITR for the last 2 financial years before the relevant financial year in which TCS had to be collected. The time limit has also expired, and the total of TCS and TDS was more than 50,000 in each of the financial years. So if you have not filed the ITR for the last 2 and the time has also expired and the amount 50,000 is exceeded, then you are that specified person and the TCS rate is going to be higher of 5% or 2 times, but shall not exceed 20%. Now, an exception to the specified person is going to be a non-resident who does not have a permanent establishment or a person who is not required to furnish the return. Now here comes the lower deduction certificate. So lower deduction certificate is mentioned under the form 13, where there are 2 annexures, annexure 1 and annexure 3, where annexure 1 is for tax deduction at source and annexure 3 is for tax collection at source. Now 206C9 mentions that not for all the transactions you can avail LDC. There are only limited transactions on which you have the entitlement or you have the opportunity to get a lower deduction or a nil deduction certificate. So the nature of transactions that are entitled for LDC are trading in alcoholic liquor, forest produce, or scrap, that is 206C1, or the contract or licensee or lease in a parking lot or toll plaza or mine or quarry. So a licensee or lessee in a parking lot may apply for a lower deduction certificate in the form 13. Now, once the form 13 is submitted, the AO may raise further query online, and which you can check in the status of the application, but is not bound to issue the LDC. He may or may not issue. It is on the merit on merit basis. Now, let's see what is the procedure for attaining the lower deduction certificate. So firstly, you're going to log in the Traces website as a taxpayer. Once you log in as a taxpayer, then under the statements column, you have an option of request for form 13, where you're going to mention what is your residential status, whether it is resident, not an ordinary resident, non-resident, then what is your request type, whether this is an original form or a revision, and for which financial year are you requesting for the form 13. Further, you're going to mention the details such as PAN, email ID, mobile number, what is the status, then what is the detail of the existing tax liability, what is the detail of the income that is to be exempt, and the detail of the advance tax or TCS which has already been paid. So all these details are to be filled as a part of the form 13. And then you're going to mention which annexure type is it. As mentioned, annexure 1 is for TDS and 3 is for TCS. Then here you're going to mention the main details for which you're applying for a lower deduction certificate. You're going to mention the tag, the section under which the TCS is to be collected. What is the nature of the payment? Which transaction are you looking forward? Which one are you wishing that the SSC wants to apply for a LDC? Then what is the estimated amount and the tax rate that you are wanting to apply? Then a list of all the documents are mentioned over there where you need to browse and upload all the documents, such as your projected balance sheet, computation. Then if you've claimed and if you have any exemption certificate of any other years, you're going to mention. Then last year's balance sheet, ITR acknowledgements, all these documents are to be uploaded, saved, and then uploaded in the website. Now comes the interest and penalties. So as this is the entire process of TCS, TDS is not a rewarding process. It is something which is the government is trying to curb the tax evasion. And in order to curb the tax evasion, there's a process of why you're not going to pay the entire tax at the end, but is going to be deducted in small parts. So this is where the tax is collected at the very start of your transaction and not at the end when you're filing your return. So there's a process, and if the procedure is not followed, then interest and penalties may be levied. So the first step is that the tax collector, the seller, has to deposit the TCS amount in Challan 281 within 7 days from the last day of the month in which tax was collected. So if it is April, in 15th April was the bill that I made, then at the end of the month, that is 7th of May, I need to deposit the TCS challan. Now, if this is not done, so if it is not collected, or if collected, it is not paid to the government, then an interest of 1% per month or a part of month shall be liable. So you become an SSC in default if you're not collecting, or after collecting, you have not paid it to the government. Now, after the next step, once you've collected and you've deposited the TCS, the second step is that you have to submit a quarterly TCS return in Form 27EQ. So the Form 27EQ is the form under which you have to submit a quarterly TCS return. So the interest that we were talking about has to be paid before your filing of this return. And here you have to also mention all the buyers that we were discussing who are exempt from TCS. In such return, you need to mention that such and such buyers are exempt. If you have an exempt criteria, then you need to mention the TCS return, the buyer exemption. Now, if you do not file the TCS return in the due date, then there is a fee. This is not an interest or a penalty, but a late fee of ₹200 per day must be paid, which shall not exceed the amount of TCS. But if you file an incorrect return, then there is a penalty. So if you have a late return, then you have a late fee. But if you file or furnish an incorrect return, then there's a minimum penalty of 10,000 and a maximum penalty of 1 lakh rupees. Now, the step 3 is going to be the TCS certificate. Once you've deposited the challan, then you've submitted your TCS return, then it is important that a tax collector provides the TCS certificate to the purchaser of the goods, to the buyer, in the Form 27D, within 15 days from the date of filing the TCS quarterly returns. Now let's look at the table of the due dates. So these are the 4 quarters. The quarter 1, whichever month the TCS has been collected, it is to be deposited in the next month of 7th. And then the quarter ending 15th July, 15th October, 15th Jan, 15th May is going to be the due date to file your TCS return. And in the next 15 days, it's the due date of TCS certificate to be given to the purchaser of the goods or the buyer. That is 30th July, 30th October, 30th January, 30th May. Now, next we have is the TRACES website. Can you see the presentation?
Yes, ma'am. It's visible.
It's visible. Okay, I'm not able to move it. Okay, so now let's see the Traces website. Traces the TDS reconciliation analysis and correction enabling system. Just I'll just share the presentation again. I'm unable to move it. I'll just rejoin. This, so sorry. There's some error. Hello, am I audible? Okay. I'm so sorry. There's been some internet connection. This I was not able to use my presentation. I just show. Yes. So we'll be discussing the due dates, the quarter wise, 7th of every month, and then the 15th of the TCS returns, and then the TCS certificate, the next 15 days, which falls to be 30th of the quarter ending next month. Now, next, let's go to the TRACES website, which is TDS Reconciliation Analysis and Correction Enabling System, which just allows TDS and TCS deductors and deductees to view and reconcile their payments online in order to file returns and seek refunds. Also, the website enables you to view 26AS, Form 26AS, and download. You can submit a request for TDS or TCS statement revisions. You can check the challan status, make a refund request online, corrections to previously submitted TDS or TCS returns. Check demands and request for correction. Now, when we look from a different lens, and that is how do we find defaults from TRACES website as a tax auditor? So this is how the page is going to look like when you go for the TRACES website. Now, as a deductor, you're going to put in all the user ID, the credentials, the password, the code. And once you've reached, you're going to reach to this dashboard, which talks about defaults here, the third column as well. So under the defaults, you have various rows which talks about to view the default summary. Now here you can know as a tax auditor, the default summary, the default for each financial year, quarter wise, you can look for what defaults has been done by the deductor. And then can also, when you look from the deductor point of view, then you can also request for correction and then track your correction request. Yes, as discussed, this is how the defaults page is going to look like, where you can go for the quarter and financial year and look for the default summary. Also on the very page, the leftmost corner, there is outstanding demand. So you can know the total outstanding demand of the deductor. Now, what are the common reasons for default? One is going to be the short deduction. Now, short deduction, common reason you get to know is that you have a lower deduction certificate. So you're going to collect less. If it is 2%, you're collecting 1%. But this lower deduction certificate is not a forever certificate. This entitlement that has been given is for a limited period, is for a year, is for a financial year. So there are times when the deductor forgets that your LDC has been expired and continues to deduct or continues to collect at 1% only instead of 2%. So then it becomes a short collection. Or there is a short payment. Now there are chances of challan mismatch. Now challan mismatch can be that what you mentioned in the challan and what is there in the return are different details. So if the date is different in the challan vis-a-vis the return, or if the BSR code is different in the challan vis-a-vis the return, or if there's a 5-digit code that is there, the challan number, that is different. So when there's a challan mismatch, they will not consider it anything else, but consider that the payment has not been done. So if there's a mismatch, and will reflect it as a short payment. So then you have to see that whether you have to go for a request for correction, then you need to pay the remaining amount of TCS or TDS, and then go pay the challan and then request for the correction and check its status. So this is how you can check your default and default summaries. I think with this, by and large, I'm going to come to an end, because TCS per se, if compared to TDS, is slightly not as vast as TDS, though now we have increased the transactions, and the transactions of overseas and LRS have increased, and the sale of goods that has come across, the TCS scope has increased. But this was from my side. Thank you so much, and would love to answer to your questions. Over to you.
Thank you, ma'am. Thank you, Shreya, ma'am, for such a wonderful session. Let's take a few questions if you have with us. Just give me a moment. I'll just check. Yeah, ma'am. We have a query from V. Subramani Iyer. She asks, is there any difference in the reporting requirement of statutory auditor and tax auditor in respect of TDS? Oops, this is with regard to TDS. Ma'am, would you like to take it?
Can you please repeat the question?
Yeah, ma'am, sure. Is there any difference in the reporting requirement of statutory auditor and tax auditor in respect of TDS?
So when we talk about, as it was mentioned, as we talk about tax auditor, when we're doing the tax audit, if the audit is not being done in any other statute, then the tax audit also requires you to check all the entire financial statements and give a true and fair view. So there, as a tax auditor, your requirement is to check the details that you're furnishing, whether it comes to be for the TDS or for the TCS. As the statutory auditor, here, the details are being provided by the management, and you are just furnishing the financial statements. And the responsibility requires is in the hands of the management. But when we have the audit report, we need to mention if there has been any interest, if there's been any default. So by and large, the responsibility remains the same, where you need to report even as a statutory auditor or as a tax auditor.
Okay, ma'am. Thank you so much. That's the only query we have. We're not able to find the third coordinator. So let me just proceed with the formal vote of thanks. Ma'am, it was absolutely enriching experience. Wonderful, wonderful session indeed. Brevity and precision, these were the essential features of your presentation today. It's not easy covering the sections, the compliances, the consequences of non-compliances. You even took us to the Traces website and where to check the defaults and what are the things we need to be wary of while doing the tax audit. I mean, it was absolutely wonderful, ma'am. Thank you so much. And I must thank WYMEC entire team for coming up with this wonderful session for the benefit of women across the country. Whoever is contemplating to come back to practice, it's absolutely commendable initiative, and the entire team of WYMEC, CA Rahul ji, CA JRG, you all have done a fantastic job, and thank you for giving me this opportunity. We look forward to hearing more speakers, and we will look forward to having more such sessions in future. Thank you so much for giving me this opportunity.